All right, I guess we can start right now. Good afternoon, everybody. This is Joao Morciani again. I know that we were expecting Tori to be presenting this webinar, but today he's on a quest to renew his passport, and unfortunately, it took longer than he was expecting. He's flying to Europe this week so he can be one of the speakers of our biofuels conference in Europe. It will be the first European conference from Fastmarkets, and he dropped the bomb in my lap a couple hours ago, calling me saying that he won't be able to make it. So I'm very sorry for that. Next week we won't have a webinar, and in the following week we will be back to the normal, and he will be back with us, and we will be able to uh, get his ideas and thoughts on the markets. So today is the August 29th Fats, Fuels and Oils webinar. Again, I'm Joao Morciani, the analyst that is focused on the South American markets. Today I will be talking a bit about this US American crop, the weather outlook, what are our expectations, and then we will talk a little bit our forecast revisions. Last week we had new data from EMTS, so with that data we've adjusted our forecast and we will share our views on that. Okay, so um, in the US, the US crop started pretty bad, as we mentioned a bunch of times over here, and it has improved significantly. We have 38% of the soybean production areas are experiencing some drought. Um, we don't have a we have a pattern on that drought, and some areas are the most critical ones. We are most preoccupied with Iowa, with some parts of Minnesota, especially the South. North Dakota also has experienced some pretty bad weather, um, and also Wisconsin. So when we look at this area's potential, we have a 500 million bushels of potential when you look at the historical data. And although weather conditions have improved significantly from June, especially, which reached 60% of air exposure to drought, next month forecast will be quite challenging to support crop conditions. Yesterday we had USDA's data on crop conditions. We had a 1% good and excellent condition drop, which is not a lot. However, the most preoccupying data that we got from that report is that 91% of the American crop is setting pods. So setting pods is the most critical period in the crop in order to define yields, and no rainfall and intense heat will not help support yields in the American crop. Um, so in the past 3 months, we can see that precipitation deviation from the average was low, but we can see that are some spots, especially over here, that were much drier than the rest of the corn belt. So we feel if but when we look at the soil moisture storage capacity, we can see over these maps that basically this bluer area, which has more soil moisture storage capacity, it's greater than the rest of the US. It overlays this drier area, which means that the rainfall that it got it in these areas are more secure and may help to support yields. So usually normal precipitation is a inch a week. So As you can see in the map, most of the corn belt had a 2 inches deviation from accumulated precipitation the past 3 months, which means that we had something like around 10 inches accumulated in this period. And that is enough to support a trend line yields. However, as those areas are, as the areas that I mentioned on Iowa, Minnesota, and North Dakota are quite bad, that made and they're not that bad right now, but they're facing severe drought, and the outlook for the first half of September is not that great. That made us cutting our soybean production forecast. We cut at 250 million bushels from it, and we took it most of this volume from our and on the supply side from our exports numbers. We also cut it a little bit from our stocks, and we haven't changed our crushing number. However, if that in the next 2 weeks, if we have this weather as severe as it's forecasted, we may cut another 250, 25 million bushels from our crushing forecast. Right now, we are 75 million bushels above USDA's numbers, so we have room to cut it. However, we are much more bullish in our crushing volumes than USDA, so we won't crush that much. And and then when we see the weather outlook for the next 2 weeks, we have a dangerous mix of basically no rainfall and really hot weather. And as we are already with almost 100% of the soybean crop setting pods, which is, as I said before, the most critical stage to define yields, that may change the crop condition right now. So as you can see in this graph, we have only significant rainfall, which is not really significant, but it is some rainfall at the end of the forecast. And as we move away from the beginning of the period that are forecasted, models used to be more less accurate. So and they rely more on climatology, which means that even that small volume may not even happen. And we have another factor that makes the outlook even worse, which is the hurricane that will hit the Gulf Coast this week. And usually hurricanes, they stop moistures coming from the Gulf to the Midwest, so they will kind of form a wind barrier for the moisture. So there will be no rainfall on the Midwest in this week or in the next week. If there is some, would be really significant volumes, and that combined with pretty rare temperatures reaching over 100 Fahrenheit degrees can hurt pretty bad yields at the U.S. crop. So these 2 or 3 next weeks will be critical to define uh, the U.S. soybean balance sheet. And as I told you last week, we had in Brazil such great weather conditions that we could test the technology capacity, and so how technology would affect yields in a good way. So we had basically ideal conditions to test how much yield, how much they could produce. In the US, we're having a kind of opposite situation. So in this season, we will test the drought resistance from seed technology, and yields will come mostly from seed technology. So that will be a quite interesting crop to understand the technology impacts and um, where are we, where US farmers are in the technological scale. Um, with that said, um, with that said, I will talk a little bit about our biofuels forecast and the EMTS data. So as you can see it, we had a 10 cents per gallon margin for biodiesel during last week, and we are expecting a 24 cents per gallon throughout the end of 2023. Margins for biodiesel were more stable than we were expecting, although we've seen some negative margins for a month ago, driven mostly by the hike in the soybean oil prices due to the concern with the American crop. But energy prices supported margins actually in a much more resilient way than we were expecting. So because of that, and not only because of that, we've raised our biomass-based diesel production, and mostly it will come from biodiesel, in part because of this resilience of biodiesel margins, and also because D3 and D5 data came stronger than we were expecting. So biodiesel will offset this increase. When we look to our 2024 forecast, we are forecasting right now 600 million gallons higher than the last forecast, and which is still below 2023 volumes. And this is a reflection of smaller refineries closing, and but at the same time, 2024 production, small refineries, they were closing in a trend, and the past months that we've seen some negative margins that may speed up a little bit that huge margins drop, as you can see it from January to the throughout the whole first half of 2023. That might accelerate a little bit some small refineries closing. So that's why we're reduction. That's why 2024 numbers are smaller than 2023. Um, yeah. So 2024 production can be even higher. We have in mind a scenario that, depending on the vegetable oil market's dynamics, uh, if that sustains higher profitabilities, we will absolutely see higher volumes. If we don't have major problems with the U.S. crop and our expectations of a huge South American crop happens, which will wait on absolutely will wait on soybean prices. We may have a better than expecting margins for biodiesel producers, and that will definitely sustain 2024 bigger 2024 volume. Uh, in the renewable diesel market, our changes were in the opposite way. Excuse me. So RD changes, renewable diesel changes were in the opposite way from the biodiesel. So we've reduced our 2023 expectations by 250 million gallons and five for 2023 and 500 million gallons for 2024. And there's a reason behind it, and it is because different from biodiesel margins, renewable diesel margins, they reflect fats and greases prices, and biodiesel will basically reflect soybean oil prices. And as fats and greases domestic supply is tight and there's no room to expand it, um, we may see that as as we are expecting a vegetable oil prices complex drop, and as renewable diesel profitability relies basically on the fats and grease markets, RD margin renewable diesel margins won't trend as biodiesel margins, and that reduces our growth expectations. As we can see it on 2023, we had a significant drop on profitability, and that drop made some people get worried about harming the new plant investments. Uh, our expectations for new renewable diesel plants hasn't changed. However, if margins goes much lower than we are expecting, we may see some. We don't believe that we will see any kind of construction. Um, we will see delays, but we won't see divestments. Um, and that will happen only if we have and only if we see profitability levels goes way below what we are expecting. So last week's renewable diesel margins were $1.96 per gallon, and we are predicting a little bit smaller margins of $1.91 per gallon throughout the rest of 2023. So so we had a reduction on the 2023 D3 production from our previous forecast. Uh, we were seeing that D3 production was growing stronger than we were expected, and now with this current data, with the last data that we got, it slowed down quite a bit. So that made us reduce our forecast on the D3 production, and we had a cut of 250 million gallons of the 2023 D4 production. We also had a cut of 8.4 million gallons on D5 and a addition of 104 to D6 fuel category. So as we lowered our D3 and D4, D5 2023 expectations and also the 2024 uh, production, it will offset the changes in the other fuel categories. So the U.S. market will overproduce biomass-based diesel mandate to compensate the other mandates. And when we look at the co-processing capacity production, I was talking with Tori about it last week. Like when this market really started to gain traction, like 5 years ago, Jacobson were expecting that co-processors would lead renewable diesel production, and which didn't happen. As you can see, the numbers are quite small and quite steady in the past years, and that is because most oil companies they prefer to ally it with existing co-processors to produce RD and not the co-processors get the most part of the production. So we have a 3.65 billion gallons of biomass-based diesel for 2023, which is 1.657 billion above the stated biomass-based mandate, and following the trend from the past years, and our forecast also keeps this trend of overproduction in the mandate. But when we see the calculated mandate, uh, we can see that after 3 years of overproduction of biomass-based diesel, we can see that after 3 years of overproduction, we will have for the first time an underproduction relative to the calculated mandate in 2023. And so we have a 306 million gallons change in Fastmarkets prediction of excess 2023 before production from the mandates. And the change is basically following the lower than expected D3 and D5 production in July. As I told you before, we were seeing a quite strong pace, and in July's data showed that they really slowed it down. So we had to review our forecast. Uh, and there's a markets are worried right now about ring prices, and there's a preoccupation on overproduction leading to a ring prices collapse. Tori talked a little bit about that in the past months, and we shared the vision that as RIN expires, we don't expect a price collapse. However, we are seeing a shift in the pricing in the ring pricing dynamics. So historically, ring prices were reflecting feedstocks costs, and in the past months, we've seen that as feedstocks prices went up, RIN prices went down. So that's a quite clear sign of that the ring pricing dynamics changing. Um, it is still too early to tell what are the other factors that are related to the pricing dynamics, the ring prices dynamics. However, we do know that oversupply is changing its pricing dynamics, and hopefully in the next months we'll be able to tell you guys what are the main factors that are driving its these dynamics. And so we reduced it for 400 million pounds for our last forecast. Our feedstock use for renewable fuel production. We have a monthly average of 2.33 billion pounds of feedstock in biomass based diesel production, and our estimate of total feedstocks in July is down 480 million pounds to 2.5 billion pounds from our prior assessment. And the reduction in the feedstock used for biomass-based diesel use, it implied in a good thing for us. It implied in a soybean oil demand that we are more comfortable with it. As you can see, May figures were quite above its historical average. Actually, the whole feedstock user was quite above. However, for soybean oil was quite high, and that was affecting our model in a way that we were not that comfortable with such a high soybean oil demand. And there's something else about our model that is usually our model it will overestimate feedstock demand. um, and this year, for maybe for the first time in a couple of years, uh, we may have total feedstocks demand under what is predicted, which is maybe a signal of a shift in the market dynamics. um, And last, as I told before, we have 500 million bushels of soybeans at risk, and the next 2 or 3 weeks will be critical to understand where yields will be for this crop. And if you have a severe damage on these 500 million bushels, you may experience a feedstock price rise in the whole feedstock market, especially because as fats and greases markets supply in the US is too tight, uh, there's no other place to run besides vegetable oils, and with higher soybean oil prices, it will bring up the whole vegetable oil complex prices up with it, and that will push the feedstocks costs a little bit higher than we were expecting. So this was this is a shorter webinar. I'm sorry again for the lack of presence of Tori in the following week, not the next week, the following one. We'll be back to the normal. And let me see if I have any questions from you guys. Okay, no questions. If you have any questions, I'll be happy to answer it through my mail or Tori's email. And thank you very much for your presence. And I hope to see you guys really, really soon. Bye bye.